Ladies and gentlemen, good afternoon. I apologize for interrupting your lunch. I would like to introduce our next speaker. First, let me introduce myself. My name is Gaël de Boissard. I'm the CEO for the European region for Credit Suisse, and I'm also the head of fixed income within the investment bank. It's a great pleasure to introduce or reintroduce, for those of you who are at the panel this morning, Dr. Jurgen Stark, who will be our speaker at lunch. We all know Dr. Stark as a famous international economist, and for those of us in the room, we know him as a central banker as well. He spent a number of years at the Bundesbank, serving as a vice president from 1998 to 2006, and from 2006 onwards was a member of the executive board of the European Central Bank, formerly in the economics and monetary analysis at the ECB, which those of us in the market think of as the chief economist. Dr. Stark is well known for his free speech and views on the European construct. In fact, he reminded us of that this morning in his description of the OMT as the outside the mandate transaction program, as he referred to it. And so we all look forward to his comments on the European situation. Of course, since his resignation in 2011, a number of developments have occurred on the European front. A number of the programs that we've referred to here, the whatever it takes statement. And in general, the European economy has done better, registering positive growth for the first time in many years. Although, as Dr. Stark commented, it has not yet recovered the levels of GDP that it had pre-crisis. It was interesting to note this morning that Europe was at the center of many of the participants of this conference's concern, but also that there was largely optimism on European equities. And so I'm sure we all look forward to Dr. Stark's speech today. In his speech, Dr. Stark will share views on the current state of the Eurozone economy. He'll consider the current issues, such as the low and anemic or meager growth rate, the stubbornly high unemployment that persists in Europe, the high and still rising levels of public debt, and I think we'll tackle one of the questions that was put to him this morning on the question of deflation and the possibility of derailing European growth at this stage. So with that, and no further ado, ladies and gentlemen, would you please welcome Dr. Jurgen Stark.
Thank you very much for these kind words of introduction. It's a great pleasure to be here, and thank you again for having invited me to join this conference. And I have to say, I'm really impressed about the size of this conference here. It's a particular pleasure to address such a distinguished audience today on the European affairs. Yes, I would like to encourage all of you to invest in Europe. There are reasons to be optimistic, and I hope that this first statement will remain or will stay in line with what I'm going to talk now. Now, ladies and gentlemen, the euro area GDP growth turned positive in the second quarter 2013, increasingly driven by domestic demand. I think this is a very important point, driven by private consumption and investment. The recession is behind us, the double-dip recession, as I also already said this morning in the keynote panel, and the recovery is broadening. However, it is still modest. It is still a very sluggish economic recovery. It is uneven across the euro area countries, and it is fragile. This year, consumption and investment are set to expand further, reducing the dependency of the recovery on the external sector. And what is also important is that growth has returned in many of the IMF EU program countries and in other vulnerable countries in the Eurozone. The situation has improved, but it is still producing disappointing results. On the one hand, on GDP growth. On the other hand, as mentioned, on these stubbornly high unemployment rates. The unemployment rate is, on average in the euro area, is still above 11%, but with the high degree of heterogeneity across member states. On the one hand, as I mentioned this morning, about 5.5% in Germany and 26% in some countries in the periphery like Spain and Greece. And in particular, the youth unemployment with more than 50% is a real issue which has to be addressed. When I say that the situation has improved but still producing disappointing results, then the question is, should we be disappointed about this? There is some disappointment about this weakness in the recovery. However, we should be not surprised because we went through a deep systemic crisis, and recoveries from this kind of crisis are slower and more fragile than typical cyclical recoveries. The fact that the euro area recovery is lagging behind other advanced economies like the US is claimed by many observers to the consequences of austerity policy and an insufficient macroeconomic stimulus. I don't share this interpretation, and I guess you will not be surprised to hear this from me, because in my view there are more structural factors, structural elements at work which have so far prevented the euro area to grow faster. In my view, the weak recovery is mainly due to slow and insufficient progress in deleveraging, slow progress in the correction of overcapacities which were built up in the boom phase, delayed and not ambitious enough structural reforms, and the defensive crisis management of European authorities and national authorities in the respective member states concerning the banking sector in 2008 and 2009. After the collapse of Lehman Brothers in September 2008, an informal consensus among European policymakers and European institutions was reached to avoid at any cost a second Lehman-type disaster, this time on this side or on the other side of the Atlantic, namely in Europe. In fact, all banks in the euro area were assumed systemically important. A bank's market exit and the consolidation of the banking sector in the euro area was made a taboo in 2008 and 2009. And from this, the euro area is still suffering today, with households and corporations still faced with debt overhang, public and private balance sheet adjustment, financial fragmentation, uncertainty and resource allocation during internal and external rebalancing have temporarily dampened consumption and investment, and this is fading only gradually, leading also to weak and heterogeneous economic performance across the member states. It is absolutely true that the current year, 2014, will be another crucial year for Europe and for policymakers, because we are still facing many challenges in Europe. The first challenge is the creation of the banking union with a new supervisory authority, which is the European Central Bank, which is in charge of the single supervisory mechanism. Please don't ask me why they call it a mechanism, but we have a single supervisor for the 128 major banks in Europe, in particular those banks with cross-border activities which are subject to the supervision of the ECB. And the creation, the establishment of a single resolution mechanism. Again, I don't know why it is called mechanism, but it is a resolution fund which will be made available over the next couple of years, financed by bank levies. So the creation of the banking union with these two elements, single supervision and single resolution, is a quantum leap in the reform of the institutional setup of the euro area. When I say 2014 will be crucial, I have in mind that the asset quality review, which is currently underway, and the results will be available in November this year by the ECB, and the stress test later this year, these are the two crucial elements which will provide more transparency about the situation of the banking systems in the euro area. And national authorities will not have the opportunity or possibility again to hide something. This will be a transparent process, and a transparent process driven by supranational institutions. So the national authorities still have a say, but it is in the interest of the single supervisor, in the interest of the ECB, not to repeat the mistakes of the past when, for instance, the stress tests were too soft and didn't get any credibility in the market or by the market. The ECB has only one shot available now. These exercises conducted in 2014 have to be credible. There is no other choice. And the tougher, the more will these exercises be credible. The second point is to deal with Greece's unsustainable debt. Greece's debt is unsustainable. Currently, with the debt to GDP ratio of more than 180%, there is a commitment, or at least an agreement, among the European finance ministers to provide additional support to Greece in order to be in a position to reduce the debt to GDP ratio, the Greek debt to GDP ratio, in 2022 significantly below 110%. So it's a long way to go, and no further major accident should happen. Otherwise, the debt to GDP ratio will be, again, significantly above this threshold of 110%. Consider from now, 2014, until 2022, Greece will be dependent on external support. At the same time, Greece tries to tap the market this year just for political reasons. I see this is a very overly ambitious approach. Maybe they will succeed with one issue, but I think this will not be a test for further issuances in the quarters to come. And the third point is the reform process in vulnerable countries more or less has come to a halt. Progress is made. I think this is obvious, in particular in the so-called program countries. Progress is made in becoming more competitive again. Progress has been made in the reform of the labor market in many countries, but there are two main countries in which this has not happened yet. This is France and Italy. And in this respect, the policy of the ECB has made its contribution in suppressing the risk premia, and in particular in Italy, not making it transparent how critical the situation is. There is no crisis awareness in some countries of Europe. At the same time, the acceptance of reforms has declined. There is a reform fatigue and, to some extent, complacency, and in the context of the position taken by the ECB to provide an implicit guarantee on the refinancing conditions of some individual countries, there is some kind of moral hazard as well. And there is uncertainty about the strict application of the new European rules, be it fiscal rules or be it a new procedure which has been created, the so-called macro imbalances procedure. On top, my fourth point, new risks and uncertainties have emerged with the geopolitical situation in the neighborhood of the European Union, with the crisis in Ukraine and the Crimean issue. This is difficult to assess what the results, what the impact will be. Apart from these issues, ladies and gentlemen, financial analysts and journalists see additional downside risks to the euro area economic recovery and the adjustment process in the periphery countries by the risk of deflation, which is the topic of today. Will deflation derail the economic rebound? There is a lot of talk about the risk of a lost decade or even a lost generation in Europe, taking into account the high unemployment rates, high youth unemployment rates, with the conjunction of no or low growth and deflation. But let me clarify what we are talking about and why we should be very prudent in using this term deflation. In the current public debate, deflation is mixed up with benign disinflation and the adjustment of relative prices. To be clear, deflation is a cumulative process of decreasing prices, decreasing wages, and output fueled by negative expectations. Deflation is a pernicious downward spiral. It increases the burden of debt and creates an incentive to defer consumption and investment, assuming further price decreases. The discussion these days reminds me of a discussion in summer 2003 about increasing deflationary risks in the United States and in Germany, apart from the discussion about deflation in Japan. The discussion in 2003 was triggered by the IMF and the then Federal Reserve Board member Ben Bernanke, resulting in a reduction of the federal funds rate to 1%. The Europeans never believed in the risk that the euro area as such, as a whole, would enter a deflation. The situation today is different. Today we are recovering from a deep systemic crisis. So the similarities are not given in this respect, but there are other similarities. On the one hand, the advanced economies are recovering from a systemic crisis. On the other hand, it is again the IMF warning against deflation in the euro area. And according to the IMF staff's econometric models, there is a 10 to 20% chance that inflation in the euro area will turn negative. The models used by the ECB show a much lower probability, not 10 to 20%, but significantly below. What about the facts? Annual inflation in the euro area stood at 0.7% in February 2014, unchanged from the outcome for January. And according to the projections and the forecasts by European institutions, but also by other forecasters, inflation in 2014 is ranging between 1 and 1.5%, 2015 between 1.2 and 1.5%, and in 2016 from 1.5 to 1.8%. According to the ECB staff's projection, which are the most recent ones, inflation is projected in 2014 to be 1%, and 2015 1.3%. And for the first time, ECB staff has projected inflation and GDP for 2016. And against the background of an expected ongoing gradual economic recovery and given rising domestic cost pressures, inflation is expected to be 1.7 or 1.8% at the end of 2016. In particular, the current inflation rate of 0.7% is interpreted as far below the ECB's target of below but close to 2%. As deflation is an imminent danger, in the view of many observers, the ECB should take immediate and decisive action. And this is seen as essential to prevent a disastrous deflationary spiral in which falling prices cause businesses and households to hold off investment and purchases, causing the economy to shrink, triggering a further round of price declines. Even if deflation is avoided, the ECB should act to fight too low inflation, many economists and commentators argue, because low inflation makes it harder for vulnerable member states in the periphery to gain price competitiveness, and it increases real interest rates with negative effects on growth and the real value of both private and public debt. Indeed, there is no doubt inflation is low. But is it too low? And is it dangerously low? Are the widespread concerns that the euro area could fall victim of malign deflation justified? And to answer this question requires a thorough analysis to understand the driving forces of low inflation. From my German, you may say, orthodox point of view, we do have price stability in the euro area, 0.7%. HICP inflation is low, but it's positive. And what is crucial for the ECB, there are no signs of deflation at the euro area level. Inflation expectations are well anchored in line with the ECB's definition of price stability. And only members experiencing structural adjustment had negative inflation rates recently, while most countries recorded positive inflation rates. Before coming back to the reasons for low inflation, let me make some more fundamental remarks which have to do with the ECB's monetary policy strategy, which might explain why the ECB does not react directly on actual figures. The ECB strategy is forward-looking. It is medium-term oriented, taking into account the time lag of monetary policy decisions, and if you like, this is by definition some kind of forward guidance. The ECB does not react mechanically to actual data. It does not react directly to the change in relative prices, but it reacts when there is a risk that the change in relative prices translates into so-called second-round effects. The ECB has shown in the past that it is prepared to prevent this kind of second-round effects. And just as a reminder, the ECB did not act when inflation was clearly above 2% and the money growth was in the double digits for a protracted period of time. Let me also stress that even 15 years after the creation of the ECB, there seems still to be a misunderstanding of its strategy and its so-called target. I say so-called because the ECB has never subscribed to the prevailing consensus view on monetary policy, namely inflation targeting. This consensus emphasized 4 elements. The first one, the targeting of inflation at a relatively short horizon. The second, the assignment of a primary role to monetary policy in the management of aggregate demand in the short term. Third, the systemic disregard of money and credit indicators in the conduct of monetary policy. And third, the asymmetric reaction to asset price bubbles as opposed to busts. The ECB does not target inflation at a relatively short and fixed horizon. And for this simple reason, it is incorrect to say that inflation is below the ECB's target, and it is wrong to say that the ECB is missing its target. And this is not just semantics. Indeed, contrary to a prevailing view, the ECB's definition of price stability has remained unchanged since 1999. The definition of price stability of an inflation rate of below 2%. However, in 2003, there was some clarification because there was a misinterpretation by market participants that the ECB is biased, that there is an upper ceiling, yes, maybe around 2%, but that the ECB has no symmetric approach, an asymmetric approach, only to fight inflation, but to fight inflation, but do not care about deflationary risks. With this clarification that within the definition of price stability, which I just mentioned, it's the ECB's aim is to keep inflation below but close to 2% in the medium term. And I think this distinction has to be made in order to understand what the reasoning behind the ECB's policy is. And I can tell you that this approach has not changed since I have left the ECB. But let me come back to the reasons of low inflation, or as some IMF economists call it, lowflation. Inflation decreased markedly over the course of 2013, in particular in the last quarter. However, similar tendencies have also been observed in other countries, not only in the euro area, as reflected in the broad decline of global headline inflation since mid-2011. The decline in inflation in the euro area is mainly due to falling energy and commodity prices, weak demand and high unemployment, the fading impact of temporary factors, in particular past increases in taxation and administered prices in a number of member states linked to fiscal consolidation needs, and the continued appreciation of the euro, reflecting inter alia the weaknesses of currencies in the emerging market economies and the weakness of the Japanese yen. But a major factor driving inflation down has been the ongoing relative price adjustment in periphery countries. It is very likely that inflation will remain subdued for an extended period of time. Cyclical and structural factors might prevent a rise in inflation. At the same time, it's very likely that the picture of price developments in the euro area will become even more heterogeneous. On the one hand, that inflation will remain subdued in the peripheral countries. On the other hand, that in the northern countries, in particular in Germany, inflation will be higher. That all in all, on average for the euro area, the inflation rate is expected to be higher than currently. Now, when I talk about the price adjustment in the periphery, this adjustment in relative prices is unavoidable, and it's a typical adjustment pattern in a monetary union. Assuming that cross-border labor mobility is still limited, price and wage flexibility is the key adjustment mechanism. And needless to stress that wages and prices are essential for economic adjustment as they directly impact the real exchange rate and thus the country's price competitiveness. In fact, wages and prices are by definition the only remaining component of the real exchange rate and can be adjusted in the absence of nominal exchange rate flexibility. What does all this tell us? Is there benign or competitive disinflation or dangerous deflation? And in this respect, I totally share the view of the ECB staff and ECB management that currently low inflation rates represent benign disinflation. It is expected to support private consumption because it boosts real disposable income And this is of importance in all Euro area member states, and in particular in the periphery. And let's not forget the positive market reaction to the crisis management measures since fall 2012. In addition, with the overall decline in euro area inflation rates, yield spreads in the reform countries over German bonds have come down dramatically, while German real interest rates have gone up to less depressed levels, as they should. Funding costs for the periphery countries have come down sharply in real terms, as yields have fallen much more than inflation in those countries. In my view, the arguments warning against outright and dangerous deflation are overdone. The current situation and the outlook for price developments in the euro area are not dangerous. If the Europeans eventually, in 2014, come to grips with their banking problems, there will be no risk of a lost decade. Bad inflation, as discussed before, in the context of its definition, can be dangerous if households and companies start to delay purchases and investment because they expect goods to be cheaper in the future. But this effect does not set in a low inflation environment, or even when prices decline modestly. It requires a significant shift in behavior of investors and consumers, as people normally react to stable or lower prices by buying more rather than less. To get into a dangerous zone of a major behavioral change, prices have to fall significantly for a long time. Over the last few months, the modest recovery underway in the euro area has shown some encouraging signs. The demand side is getting stronger. Consumer confidence is rising, and savings rates have been stable, or savings rates have even declined, for instance, in Germany, in favor of higher consumption. Currently, there is no evidence at all of people postponing expenditure plans. What Europeans would like to achieve, and what they have to achieve, is to get back to a medium-term, sustainable and non-inflationary growth path, rather than to an artificially inflated, distorted and short-lived recovery. The key point, the key element in this respect is to go ahead with structural reforms. Empirical evidence show that product and labor market reforms, as well as fiscal consolidation, benefit potential output in the medium to longer term. Deregulation of services, if it increases competition, leads to higher investment and greater growth in total factor productivity. And higher total factor productivity is achieved through improved incentives for innovation, adoption of technology, and eliminating inefficiencies. There's also empirical evidence that labor market reform, the reform of unemployment benefits and the retirement systems, as well as activation policies, increases the steady state employment levels, albeit in a slow and gradual way. So there is no other choice than to go ahead with structural reforms, also to take into account the aging and declining population in Europe. We have to foster productivity in order to compensate, at least in part, this effect of the aging and declining population on potential output. Concerns the risk to GDP growth and price developments, a new major downside risk has recently emerged. I mentioned it already, the increasing political uncertainty and the geopolitical tensions in the eastern neighborhood of the European Union. These tensions could escalate to a military conflict or a war between Russia and a trade war between Russia and the West. Trade war, not war. The impact on our economies is difficult to measure at this point in time, We don't know, we know when we enter such a situation, but we don't know the dynamics of such a process, and we don't know the exit. The impact is difficult to measure. For instance, concerning exports from the European Union to Russia, but also the reliance of EU member states on Russian energy exports, be it oil or natural gas. And not to forget the capital movements. You could see today in the FT's front page the capital outflows from Russia. I think this will continue, at least in the short term. In any case, where we are today in the euro area, whether we are facing a deflationary environment or not, what is key that the ECB still have instruments available to fight deflation if really the risk would increase. Official rates are already at historical low levels, but excess liquidity has declined since the end of 2012 as banks' demand for refinancing has declined as well. This should be seen as a positive sign that because it is a market-driven process, that banks need less liquidity in the current circumstances. There is also room for the ECB for a new long-term refinancing operation, as the ECB did at the end of 2011 and early 2012, possibly conditional on the bank's lending behavior. And furthermore, the ECB could either activate OMTs or engage in a different operation in purchasing assets other than government bonds. However, what I would like to say here, in the case of an increase in deflationary risks, the ECB still has ammunition available. However, what is key for the central bank is the effectiveness of its action rather than the action itself. Thank you very much.
Okay, thank you very much, Dr. Stark, for some very open comments. There's a lot of topics to cover in Europe. My name is Helen Howarth, and I run our interest rate strategy research team based in London, and I would agree very much with the comments that Dr. Stark had made in terms of the AQR and the importance that if the ECB get that right this year, that could be a very important turning point for Europe. So at this stage, we'll move on to the Q&A session. I'll start off by raising a couple of points because I think it would be remiss not to ask about QE since you skirted around it during the talk, and then I'll open it up to the floor. When I do, if you could make sure your question contains a question, because I think there'll be lots of interest from everybody for Dr. Stark. So just to start off then, we had a talk just a couple of weeks ago from Draghi. We're used to some pretty strong language from Draghi that we should pay notice to in the markets. And he said in terms of guarding against deflation that the ECB has been preparing additional non-standard monetary policy measures to guard against deflation and stands ready to take further decisive action. Now, they're quite strong words, and I guess my question would be if the ECB does take such decisive action, in your opinion, what do you think that would be? Is that going to be quantitative easing? Is it going to be further cuts in the interest rates, going to a negative deposit rate, or something else? And obviously, the implications for the market and for the economies is quite different between negative interest rates versus bond purchase programs. So maybe if you could also elaborate in terms of what you think might be a trigger that would justify the ECB going into negative interest rates versus a trigger that would warrant a bond purchase program.
Mr. Draghi's message was twofold. The first one, that the ECB Governing Council does not see this risk of deflation. However, this was the second part of his message was, if this were the case, that the deflationary risks to increase, then we have still ammunition available. What in that case the ECB is going to do, it is up to the Governing Council. As you know, I'm not a member of the Governing Council anymore, but I could imagine a further rate cut with the main refinancing rate going down maybe to 0.1%. But what is discussed in the Governing Council is a negative deposit rate. However, nobody can tell you and me what the impact of such a rate cut is likely to be, whether this will be interpreted by markets as an alarm signal that there is deflation. It could be interpreted that the ECB is desperate because it's moving now to negative deposit rates, and we don't have any evidence what negative deposit interest rates really trigger. There were only, in my view, two cases, to my memory, two countries or two central banks which moved to negative deposit rates, namely the Central Bank of Denmark and the Central Bank of Sweden, the Riksbank of Sweden. And the results were mixed with this operation. So again, when I was at the Executive Board and the Governing Council, I always argued on 2 points. First, we must be certain about the effectiveness of our measure. And second, if we embark in new measures, we should know how to exit and under what circumstances. The 2 key points, effectiveness and exit. So you have to get back again. So interest rate cut is one possibility. I expect that in the case of increasing deflationary risks, the ECB would choose the liquidity instrument rather than, a new long-term refinancing operation rather than to embark in quantitative easing. Draghi has made clear quantitative easing may be a tool, but not necessarily in purchasing government bonds, because this is not in line with the statute of the ECB to purchase government bonds in the primary market. It is permitted to purchase government bonds in the secondary market, but there is the ongoing discussion whether, also referring to my statement about the OMTs, that this is maybe not in line with the mandate of the ECB. So maybe purchasing other assets rather than government bonds. So just to say there are instruments available. I could expect a combination of 2 elements, a rate cut, and second, additional liquidity measures.
So these conditional LTROs that you spoke about?
But
the conditional LTROs that you spoke about.
Whether conditional or not, the central bank cannot force banks to provide credit to the real economy. So this is up to the banks to decide. So what the ECB can do, or what a central bank can do, is just to provide additional liquidity. What use is made of this additional liquidity, it's up to the management of the respective bank.
In your talk, you outlined some of the challenges that are still facing the peripheral economies. I think in the markets, if you look at the consensus positions that people have held this year, the one that's never been tested is basically owning peripheral bonds. So a lot of people are very overweight the peripheral bond markets in Europe. You mentioned that Greece is looking to tap the markets again. I think for those of us who were involved in looking at the Greek debt restructuring, which was only 2 years ago, we would have been pretty surprised if we'd been told that just 2 years later they might be looking to come and issue again. If they do manage to issue, do you think that might mark the top, and this is the point when we should take off those consensus positions?
I have not been asked by the Greek authorities whether I would advise to tap the market in the current circumstances or to postpone it and to wait and to produce better results in the implementation of the IMF EU program. I would have given the advice to wait and not to be overly ambitious. But the Greek government seems to be driven by purely political considerations to demonstrate to the Greek electorate just before the elections to the European Parliament, just to demonstrate, yes, it was worth to go through this painful exercise in implementing reforms, in cutting wages and so on. And now we are back and we are confirmed by market participants that we have access to the market again. It's just for political considerations, but I think it's also a dangerous exercise because it also could fail. So Greece should wait for a longer time. You know that the Troika just last week came up with this assessment, which was expected already in September last year. So with a couple of months delay about the program review, which was due in September, it came up now in March. So 6 months later. This shows that there are still severe problems in the implementation of the program. Not to deny that progress has been made, but Greece is not in a position to be on its own. And Greece, as I said earlier, will depend on the European support for an extended period of time, European financial support. But this has a price. A price has to be paid. This price is conditionality. There will be no financing without implementing the program. However, Europeans and the IMF have been extremely generous with Greece already. Greece was insolvent in spring 2010, but was treated like a liquidity problem. It was insolvent again at the end of 2012 when the Greek Central Bank, via emergency liquidity assistance, financed the banks, and the banks financed the government for about 3 months, from September to December 2012. Little progress has been made in the privatization process. There was the commitment, the promise, until 2015 to privatize, to go ahead with privatization in order to get revenues of up to 50 billion euros. This will not happen. It has not happened. And the current situation is not encouraging to ask investors or for investors to go to Greece, because the situation remains uncertain. So if I were asked to give advice to the Greek government, I would recommend not to try to get back to the market at this stage.
Thank you very much. Do we have any questions? Whenever.
Dr. Stark, there was an article in Financial Times this morning detailing the current issuance thus far this year. Some countries have already done half their issuance, and we're in March now. So, and this is far above average, even though we do see more issuance in the beginning of the year. So if you could comment on that, are European countries sort of front-running risks possibly for the rest of 2014? How does that reflect in bondholders' confidence this year? And also, if you could comment on the ECB minutes, the release, where you see that discussion going.
First, I think it's an encouraging sign that program countries like Portugal and former program country Ireland, but also a vulnerable country like Italy, were successful in tapping the market recently at very low rates. And again, in my view, these rates are too low and do not represent the risks, because the risk premia are suppressed by the implicit guarantee provided by the ECB. So these are not market rates currently. These are rates which do not reflect the real risk some countries are still facing. Ireland is slightly different from Italy, but we see in particular suppressed risk premia in Italy. But there is an overall sentiment in the financial markets. The worst of the crisis in the euro area seemed to be over. And maybe they are right. The worst seemed to be over. And at the end of this year, and for me it is crucial, The banking union issue is crucial, and the tests which are conducted now are crucial. At the end of this year, we will really see that that the crisis is behind us. There will be another issue, the exit of the ECB from the of the OMT commitment, the OMT promise. How to get out of this promise? If Mr. Draghi would say in the next press conference, the crisis is over, we succeeded, markets have calmed down, we see progress everywhere, there are no deflationary risks, and countries are now on their own, we will withdraw the OMT, then you will create a disaster. So I think the OMT will be with us for quite some time. There is no early exit and no easy exit from this instrument. Concerning your second question on the ECB minutes, my suggestion has been, but I failed in this respect, to convince both presidents with whom I worked with, namely Jean-Claude Trichet and Mario Draghi. I said we have to be more explicit, provide more detailed information, discuss more the pros and cons which are really discussed in the Governing Council meetings, and to broaden the statement and to call the so-called introductory statement which is presented by the president of the ECB at the start of the press conference as a monetary policy statement. And also hinting, not making transparent the names, but just to hint the majority and minority relations. And in particular, to discuss more openly the pros and cons and why in the end the Governing Council came to the conclusion to raise rates, to leave rates unchanged, or to lower rates, or to embark in new non-conventional or non-standard measures. So I do not expect a publication of the minutes, but I expect more transparency in particular the current circumstances when new measures might be discussed, or the ECB to prepare at a certain point in time for the exit from some measures. I think more transparency is needed, but I expect from my point of view a broader statement made public and discussing the pros and cons which are behind the policy decisions.
We've got 1 minute literally left, so something very quick down the front here.
Regarding the exchange rate, at which level do you think that the strong euro is going to be a too strong headwind for the European recovery? And second part, where do you see euro-dollar in 1 year's time?
Sorry, where?
Where do you see the euro-dollar in 1 year's time?
This is $1 million question. Timing and the level of the rate, impossible to answer. Impossible to answer. To your first question, not at present. I think the euro is not that strong. It reflects the weakness of other currencies. So trade-weighted, the euro trade-weighted vis-à-vis the currencies of the 20 most important trading partners of the euro area, trade-weighted, the euro is currently ranging 3% above the long-term average. So currently, in my view, there is no problem. The case of a further appreciation, which in the end will also have an impact, and this is key for the ECB, an impact on the inflation rate, a further appreciation will have an impact on the inflation rate, then the ECB might see a trigger point for intervention and to take action, but not at the present level. I know the problems which could increase, in particular for countries which are in the process of adjustment to regain competitiveness, that the current appreciation of the euro is not welcome. Other countries, other economies can deal easier with the current level. But I don't see at the current situation a real risk for the euro area as a whole.
Please join me in thanking Dr. Stark for some very helpful and insightful comments. Thank you very much.